Hello everyone, welcome back to the channel. In this video, we are going to start financial management audio series. This is chapter number 1, scope and objectives. Meaning of financial management. Financial management comprises the forecasting, planning, organizing, directing, coordinating and controlling of all activities relating to the acquisition and application of financial resources of an undertaking in keeping with its financial objectives. Now, there are two aspects of financial management. One, procurement of funds. Second, utilization of funds. These two topics will be discussed in later chapters. The next topic, finance decisions. There are two types of finance decisions. One is long-term finance decision and short-term finance decision. In long-term finance decision, we have 3 points: investment decision, financing decision, and dividend decision. In short-term finance decision, we have working capital management. Now, scope of financial management. Point number 1, determination of size of the enterprise and determination of rate of growth. Second point, determining the composition of assets of the enterprise. Third point, determining the mix of enterprises financing, that is, consideration of level of debt to equity, etc., and short term functions or decisions. Fourth, analyzes planning and control of financial affairs of the enterprise. Next concept, procurement of funds, which means the various ways of how funds are procured to the company. 1. Debentures and bonds. 2. Hire purchases and leasing. 3. Angel financing. 4. Venture capital. 5. Commercial banks. And 6. Owners fund. Next concept, effective utilization of funds. 1. Utilization for fixed asset. 2. Utilization for working capital. Now, objectives of financial management. The first objective is profit maximization and second objective is wealth or value maximization. Next concept, how do we measure the value or wealth of a firm? First point, stockholders hire managers to run their firms for them. Second, managers set aside their interest and maximize stock prices. Third, stockholders' wealth is maximized. Fourth, societal wealth is maximized. The formula to calculate value or a wealth of a firm is value of a firm is equal to number of shares into market price of shares, or value is equal to value of equity plus value of debt. Next concept, three important decisions for achievement of wealth maximization. 1. Investment decision. Selection of assets in which funds will be invested by a firm. Second, financing decision. Acquiring the optimum finance. Next, dividend decision. Determination as to how much and how frequently cash can be paid out of the profits. Working capital management. Generally, short-term decisions are reduced to management of current asset and current liability. The next concept, the conflict between profit versus value maximization principle. As a normal tendency, the management may pursue its own personal goals, which is profit maximization, but in an organization where there is a significant outside participation, like shareholding, lenders, etc., the management may not be able to exclusively pursue its personal goals due to the consent supervision of the various stakeholders of the company, like employees, creditors, customers, government, etc. Now, let us see the advantages and disadvantages between profit maximization and wealth maximization. Profit maximization. The objective of profit maximization is large amount of profit. So the advantages are easy to calculate profits, easy to determine the link between financial decision and profit, whereas disadvantages of profit maximizations are emphasizes the short-term gain, ignores the risk or uncertainty, ignores the timing of returns, requires immediate resources. Now let us go for wealth maximization. The objective of wealth maximization is highest market value of shares. So the advantages are emphasizes the long-term gains, recognizes risk or uncertainty, recognizes the timing of returns, considers shareholders' return. Now the disadvantages are offers no clear relationship between financial decisions and share price, can lead to management anxiety and frustration. Now, the next concept, role of finance executive in today's world. In a large organization, a finance executive or a CFO is a treasurer or a controller. Role of treasurer is cash manager, credit manager, capital budget manager, fundraising manager, and portfolio manager. Whereas controller is a financial accounting manager, cost accounting manager, tax manager, data processing manager, and internal auditor. That is it for this video. We will complete the chapter 1 in the next part. Thank you for watching. Subscribe and share.